A very good evening and welcome to the third episode of our currency trading series. Today we'll be discussing about the most common currency pair, that is the dollar rupee, or commonly known as the USD-INR. In this video, we'll be focusing on what drives the currency pair, what drives the USD-INR, how is the price action, where to trade it, and how to trade it. So before getting into all the rigmarole, let us look at how the participation has been over a couple of years. So there are two line charts that you see here. One is a dotted line chart, that is the total volume. And the second, the thick blue line, that is the 5-day average volume. Now, if you look closely on the chart, there is this red area marked, and this actually shows the surge in the participation in the weekly contracts. And if you observe closely, the participation has consistently been increasing. So now we'll come to the next question that is very common and comes quite often in the minds of people. Why do we trade currency, or why do we trade the dollar rupee? Now we have tried to sum it up in three short points, and this applies for dollar rupee specifically in this case. So the first is ultra low margin, the second is the longer or extended trading hours, and the third is the low volatility. So let us dig deeper into it. So when we talk about ultra low margin, what do we really mean, or how low the margin really is? So for a base case scenario, we have Nifty here and we have USDINR. So when we're talking about Nifty, now these current market prices, they're hypothetical. So we have Nifty trading at say 16,400 and the dollar rupee trading at 78. So the contract value is basically the current market price into the lot size. So assuming that Nifty is trading at 16,400, the contract value comes to about 8.2 lakhs. And for the dollar rupee, the contract value comes to about 78,000. The margin required for trading one lot of Nifty is 1 lakh 3,000. While on the other hand, the margin that is required for trading one lot of dollar rupee is just 1900 rupees. So if we were to calculate the leverage, that is, basically divide the contract value by the margin, we get about 8 times when it comes to Nifty and about 40 times when it comes to the dollar rupee. Now the next point, the longer trading hours. Now, when we say Nifty here, we mean in general the equity market. So when we are talking about the trading hours, we know that the equity market, trades between 9:15 a.m. to 3:30 p.m. on a weekday. On the other hand, the currency starts at 9 a.m. and ends at 5 p.m. So you have that extended trading hours to carry out your trading activities. The third point is low volatility. Now, if you have been in the currency market, or if you have been in the market for quite some time, you know that RBI intervenes in the currency market from time to time. Now, this is basically done when there is volatility expansion. When there is extreme expansion in the volatility, RBI is uncomfortable with it. They participate in the market. Similarly, if there is brisk appreciation and brisk depreciation in the rupee, RBI intervenes and it tries to limit the appreciation and depreciation both. So, in this process of controlling the volatility and preventing or trying to minimize the brisk appreciation and depreciation, RBI ends up putting the dollar rupee in a range. So this is basically a heaven for option writers. Now, as to why it is a heaven, we will be coming out with a separate video. Do stay tuned for that. Now, how is this helpful for futures traders? So, unlike Nifty or Bank Nifty, we don't often see exponential moves in currencies because obviously RBI is there to monitor whatever is happening in the currency market. So they keep the volatility in check. So the amount of loss that one might incur if they are long naked futures might probably be limited as compared to the Nifty or the Bank Nifty. Might probably be lesser as compared to the Nifty or the Bank Nifty. In this slide, we have actually shown the volatility comparison. And if you look at the chart or if you look at the table, you can see three instruments, that is the Nifty, Bank Nifty, and the dollar rupee. Now, in the first column, we have shown the volatility points. For the Nifty, it is about 228. The Bank Nifty is 706. And for the dollar rupee, it's 30 paisa. The contract size is nothing but the lot size. Now, the money value of volatility is basically a product of the volatility and the contract size. So that comes to about 11,400 for the Nifty, 17,650 for the Bank Nifty, and 300 rupees for the dollar rupee. Now, the margin required for the Nifty, it is about 1,03,150. For Bank Nifty, it is 1,42,537, and for the dollar rupee, it's 1,900. Now, if we look at the volatility per unit of margin paid, so this is basically a ratio of the money value of volatility and the margin. So if you see, dollar rupee is the most efficient, is more efficient than the Nifty and the Bank Nifty. So the dollar rupee gives you about 16 units of volatility per margin, per unit of margin, and for the Nifty and the Bank Nifty, it is 11 and 12 respectively. Now we'll understand the quote. So, say for example, if we say that the dollar rupee pair is trading at 77, that means the buyer of the contract has to pay 77 rupees for the pair. So now, like we did in most of our previous videos, we'll assume a scenario where Mr. A has purchased a lot at 77. So now, we'll take scenario one, wherein the prices move up to 77.50. So Mr. A is in a much better position today because he'll be able to sell the pair that he purchased at 77.50, so that he purchased at 77 at 77.50. So he's making a profit of 50 paisa. On the other hand, if it drops to say 76.50 on the downside, so he'll be able to sell the pair currently at 76.50 that he purchased at 77. So he's incurring a loss of about 50 paisa. So now, what the price movement is, or what, how does your PNL or how is your PNL affected with the price movement? So here we have taken a base case scenario where the dollar rupee is trading at 77, and the lot size the lot size is 1,000, and the number of lots here we have considered as one. So the value is nothing but the lot size into the price, so that comes to 77,000. And say, for example, the dollar rupee goes from 77 to say 77.20. So here the lot size increases from 77,000 to 77,200. And so does the profit. It goes from 0 to 200 rupees. Say there is another jump from 77 to say 77.40. So in that case, instead of making a profit of 200, now he's making a profit of 400. Now let us look at the other scenario. Here, say Mr. A has purchased at say 77, purchased the pair at 77, and the price has actually fell down to 76.80. So here he is incurring a loss of 200. Similarly, if it falls deeper to say 76.60, his loss will actually keep on increasing and it will go to 400 rupees. So now that we know how to understand the quote, what the participation has been, we'll now take a look at what are the factors that drive the dollar rupee. Uh, so obviously, the chronology in which I'll be telling has got no meaning. I'm just going with the flow. So the first factor that we'll look at today is the dollar inflow and outflow, followed by the equity market trends, the dollar index, the dollar, US dollar and the Chinese yuan, then the Brent crude oil, and then the US 10-year bond yields. Now, all these factors are equally important. None of the factors are more important than the other, so the chronology has got absolutely no significance here. So first we'll look at what the FPI flows, how the FPI flows affect the dollar rupee. So basically, when we say that the FPIs are bringing money in India, they bring in dollars and then they have to convert the dollar into rupees. So they have to sell dollars and buy rupee. So by default, the dollar supply increases and the rupee is in demand. So the rupee actually happens to appreciate. That means the USD/INR pair will actually start moving down. Similarly, now for example, we can take into consideration from April 2015 all the way to say January 2017. If you see the FPI flows have been more or less like in and out. Now, in such a scenario, you can see the dollar rupee was more or less in a range. Now, if say for example we have a situation something like we saw in April 2020. Now, if I'm pretty sure most of you might remember it was the initial days of COVID, and we had massive pullouts from the foreign investors, and that led to a surge in the demand of dollar, and we saw the pair move higher. That is, the rupee actually happened to depreciate. And if you want a clear picture of what is happening right now, if you go to the fag end of the graph, you can see those histograms actually going below zero. That means there has been a pullout. And if you take a look at the black line chart, that is the dollar rupee, it is depreciating. The rupee is depreciating against the dollar. The dollar here is gaining some strength. Now, coming on to the USDCNH and the USDINR. Now, the biggest question that comes to people's mind is मैं डॉलर रुपी ट्रैक कर रहा हूँ मैं चाइना की करेंसी क्यों देखूं सो CNH इज चाइनीज युआन सो मैं चाइना की करेंसी क्यों देखूं so the simple justification here is China is the third largest economy in the world and is one of the biggest emerging market economies. So if something is putting pressure on the Chinese yuan or something is pushing the Chinese yuan lower or say the Chinese yuan is depreciating against the dollar because of some reason, it is going to affect the other emerging markets. Long story short, India is an emerging market and China is also an emerging market, one of the biggest emerging markets in the world. So if something is going to put pressure on China, India is also going to be affected by that. That is why we take a look at USDCNH to gauge what the dollar rupee is going to be, or how the dollar rupee is going to move. And if you see to a great extent, both of them they actually move on similar lines. I mean, you cannot expect the exact chart pattern to be the same, but if you see when the Chinese yuan was appreciating, we saw some appreciation in the dollar rupee as well. Here, the blue line is the Chinese yuan, the red line that is the dollar rupee. When the Chinese yuan started depreciating, that's the USD CNH started moving higher, we saw up move in the USD INR too. So tracking Chinese yuan to trade USD INR is always a good idea. Now, Nifty and the dollar rupee. So this I'm going to explain to you in a risk on risk off scenario. So what risk on basically means is people are willing to invest more in risky assets, say equities, and they are fine with taking money out from the safe haven, putting it into equities. And similarly, that's the exact opposite in case of a risk off. That is, there is some uncertainty. People run towards safe haven and by liquidating most of the risky assets. So what happens here is if there is a risk on scenario, I mean the Nifty moves higher when there is a risk on scenario, the equity markets will start out for performing, and Nifty 50 is India's benchmark for the equity markets. So if that moves higher, that means the equity is having a good day or a good week or a good month or a good given period, whatever it is. During that time, we will see some, pressure on the dollar. So that is why you will, especially in this phase or towards the end of the chart, you can see that as the Nifty moves higher, the dollar rupee actually goes down, or the dollar rupee pair it moves lower. So the INR or the Indian rupee appreciates against the dollar. Now that correlation is inverse. That is, if the Nifty moves higher, the dollar rupee goes down, and if the Nifty moves lower, the dollar rupee goes higher. And that actually becomes very clear when we go towards the end of the chart, that is the May 2022 part. So you can see this crossover right here, and that is when the Nifty started falling and the dollar rupee started moving higher. Now, the next factor, the dollar index and the dollar rupee. Now, the dollar index, also called as the greenback, so what it does is basically tracks the dollar's performance against a basket of currencies. So when we say that the dollar index is moving higher, that means it is outperforming when you compare it to other basket of currencies. uh, Six currencies basically. So if the dollar is appreciating against six currencies, it is appreciating against the rupee as well. So that is why if you look at the chart, the dollar rupee chart and the dollar index chart, they have a similar structure. I mean, I'll advise you to ignore the minor niggles here and there because there will be other factors that will be affecting the dollar rupee. But if you look at the basic structure of the chart, when the dollar index moves lower, the rupee also moves lower. That is, the rupee gets stronger. When the dollar index moves higher, that is when the dollar is stronger. the dollar rupee also moves higher. That is, the rupee depreciates against the dollar. Now, the US 10-year yields. So, recently we had a situation where the US 10-year yields were going off the roof. Now, one might ask why this happened. So, this was basically because of the Fed rate hikes. People were switching to higher yielding dollar. Now, Fed is still raising interest rates by 50 basis points in every meeting. So the dollar becomes dearer to the investor. So they pull out money from low yielding currencies and they end up putting it in higher yielding dollar. So that is why there is always a direct correlation between the US 10-year bond yields and the rupee. So in the morning, if you see that the US 10-year bond yields are moving higher, there is a big probability that the rupee is going to depreciate against the dollar during the day. The next factor is crude oil and how it affects the dollar rupee. So this, I believe, is quite self-explanatory, and I'll put it in really simple terms. We are massive importers of crude oil. So a higher crude oil price is going to hurt the rupee or hurt the economy in general. Now this happens because our balance of payments get affected. Now balance of payment is not something that we can cover in this video. It's beyond the purview of this video, but we'll definitely try to come up with a follow-up video in which we can explain balance of payment. But for the time being, if the crude oil moves higher, the rupee actually happens to weaken against the dollar. The next factor that we can look at is, or probably now that we know most of the factors that are driving the dollar rupee, the question arises how to trade dollar rupee. Now, dollar rupee is a derivative product. I mean, it's a derivative, it's a currency derivative. So you basically, like any other derivative contracts, you have options and futures. And under options, you have calls and puts. Now, fortunately for the dollar rupee, most of the contracts that are being traded, be it weekly or monthly, are super liquid. You can trade freely. I mean, there is no liquidity crunch. The slippages might be very low. But that said, you have an option to trade in the weekly or the monthly options and futures. Now the question arises where to trade. Now, if you don't have a Kotak Securities account, the first thing that you should probably do is open a Kotak Securities account by visiting our website, www.kotaksecurities.com. Fill up the details, and then it will ask you for your credentials, log in, and you can create a watch list like I have done in here. So now if you see under watch list, there are multiple watch lists and I have selected currencies. And if you see under currency, I have the 28th June dollar rupee future. And on the downside, I have three put contracts. And on the upside, I have three call contracts. And if you're not comfortable trading on our website, you can also download our mobile app that is available both on iOS and Android devices. And you can start trading by downloading that app and logging into it. Now, as to coming back to the question, why the dollar rupee is an option traders go to place, or why is it considered a heaven for option traders? We will be coming up with a video quite soon, and the topic of the video will be why option traders love the dollar rupee, or why option traders love USDINR. For that, you'll need to subscribe to our channel, click on the bell icon so that you stay notified when we come up with a video. Uh, I hope this video was quite informative. I hope you learned something from this. I hope you enjoyed watching the video. And uh, so that's all for this video. We'll sign off at this point, and do tune for the next video. And till then, stay safe, trade safe. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.